Hey guys, welcome to the second session on how to grow a small trading account of around $10,000. So in last week's session, we went over, foundation and mindset, why most small accounts fail by over leveraging, the power of journaling. We went through that in depth. The math of survival, asymmetric loss versus gain, position sizing and risk management, and why going big is a surefire way to failure. Today, because obviously I've limited time each day to cover these topics, but today we're going to delve into session two, which is strategies, right? Obviously, naturally, the next progression is how do I actually grow my account and what strategies are good to be using, right? So in this, we'll cover why strategy choice is constrained by account size, margin requirements versus buying power, avoiding naked options, define risk being paramount, obviously, core strategies, and then underlying selection. So the first thing is that with a smaller account, you're not able to do all the strategies that a more well-capitalized account is able to do. And that's just a function of not having enough margin in your margin account to actually open positions that larger account is able to open, for example. Having buying power to buy a higher price name, let's say a Tesla at like $405 a share, or an Amazon at 248 roughly, or a Micron, which is trading over $1,000 per share. You're obviously very limited, right? You can't just go out and buy 100 shares of that asset if you're trying to trade options on it. And so you're kind of focused on strategies that allow you to grow your account in a responsible way, but from a small number and small risk overall. And so these strategies really are all around, well, to start off, long puts and long calls, right? You buy a put option, you buy a call option, you have unlimited upside on the call option. You have theoretically, well, not really unlimited upside on the put option because the maximum you can make is from your strike price to zero. But if you look at an option chain, and let's look at, for example, NVIDIA over here, because we used that as an example last week. I'm going to use NVIDIA because it's a name everyone understands, knows for the most part, and we're all familiar with it. I want to be consistent across these modules anyway. So right now you have an asset that's $210 approximately USD per share. And to buy 100 shares would cost you about $21,000 US, right? The reason why I mentioned 100 shares is because each option contract that you buy gives you the right to buy or sell 100 shares of that asset. So if you're buying, for example, the 200 strike call option that expires in July, which is about a month away on NVIDIA, and you say, you know what, I could buy 100 shares if I had $21,000 in my account. Again, we're presuming here that you have maybe 10K in your account. Well, instead, you're far more limited, right? You could buy instead a position that acts almost as a proxy for owning NVIDIA, in that you buy a call option at the $200 strike price. That would be in the money, and you'd be paying about $15 for that contract, which means you're paying $1,500 because each contract covers 100 shares. And not diving into like the nuances of the Greeks here, because that's not the point of this discussion, but essentially here you're paying a premium of about $5 over the current price. That's the cost of doing business by having this leverage in your portfolio, because as a 10K account, you could not afford to buy 100 shares, but you can buy one call option. And so with this in mind, let's say you have a thesis, for example, that NVIDIA is going to run to 230 by the expiration date, July 17th. Well, if you were correct of that assumption, you would essentially double your money on this position. So you turn $1,500 roughly into $3,000. And on a 10K account, that would require you to risk 15% of your account to make a return of 15%. Now, on that note, let's say you're bearish instead on NVIDIA, obviously, right? You could buy a put option and you could buy one in the money as a proxy for being short the stock. Again, a similar idea would be buy the 220 strike call, put option, $15 roughly. And let's say you thought it was going to go to 190, for example, by July 17th, then you would make $15 profit on this put option. But notice how on both these contracts, there is a premium attached to that. You're paying a $5 premium above the current price. That is the risk premium on these options, right? Because naturally, if options traded at a pure intrinsic value where there was no detriment to you owning the option versus the stock, there would be no impetus for anyone to actually own the stock. Everyone would just own the options because they're a fraction of the cost and they're far more capital efficient. Um, the way you can kind of think about this is a little bit is like, getting a mortgage on a house versus buying it cash outright. Buying an option is similar to buying a mortgage. The only difference being that you have no collateral behind buying that option, right? If you want to actually own the asset at the expiration date, you need to have enough capital to take assignment of that asset. And given that NVIDIA is, 210 a share roughly, you need $21,000 in capital or equivalent margin in your in your account in order to actually take assignment of, for example, a $200 call option if it expires in the money. So you have these, basic strategies: buying a call, buying a put, and you might think, okay, well, I could buy an out of the money call or out of the money put as well. And that is a reasonable assumption because obviously the asymmetry of risk is pretty incredible. You can go out of the money further and further, and the further you go out of the money, the cheaper the option gets. But the trade-off is that the probability of that option expiring with some value is not very high. You require a much, much larger move to occur in your favor very quickly in order to make money on that position. This is why brings us to our next kind of discussion point, right? Because I don't think buying single legs calls or puts is the most constructive way to grow a small portfolio. You have to take too much risk on a percentage basis to make perhaps great reward, but at the same time, you want to be consistent here, right? The focus is on being consistent, not on hitting the one-off home run where you might double your account value very quickly, but alternatively, you might lose half your account. So if we go from just, a long call or a long put, we focus now instead on vertical spreads, debit and credit spreads. These are the best options because they're defined risk and they require far lower capital. So going back to our discussion on NVIDIA, it's like my screen is a bit frozen. There we go. On the same line of thinking that we had before, instead of just buying the call option, we can, in our margin accounts, sell a call option against our call option, or we can sell a put option against our put option, right? Creating a call spread or a put spread. Now, let's say, for example, that the first step that I always take myself, just for you guys to know, is I look at the straddle price, because that gives me an inclination as to what the market expects the underlying asset to do by a certain expiration date. So the current closest strike price to the current spot price is 210. And the straddle right now is pricing in, if you combine these costs, you have 210 call and a 210 put. And the combined cost here is about $17.20. That tells us that the market expects NVIDIA to move up or down from this current price, 210 roughly, by about $17 by July 17th. So now we can kind of like look at a chart and say, okay, well, given that we know that the market's pricing in this kind of range, how do we want to express our overall positioning there? Again, one sec, guys. When I have Zoom running and IBKR with all the charts and stuff, it bogs my system down. It doesn't matter how much RAM you have. It's IBKR is a huge RAM hog. So here we go. One sec, guys. So looking at the chart, we can establish essentially the range on the chart ourselves. So we draw two lines, $17 above and below the current price. So 210 minus 17 is 193, somewhere around here. You notice I have this alert set from our morning meeting, which we discussed a trigger point to go long here and buy some calls or perhaps stock here, perhaps if it goes that low again. And then the other point would be 210 plus 17, which is 227. So near the highs over here. So now you have this kind of range established, right? We can go up or down from the current price. We can go up to here, or we could also go down to here. That's the range we're looking at for the month ahead. So
Does the
this is a good way to
ATF
think.
link have that?
This is a good way to think about. Sorry, guys. John's mic was open there. This is a good way to think about how to structure your trade, right? Unfortunately, right now we're kind of in the middle of this of a range here. It looks like we're going to break back up toward highs again, but we're not at a really great point to give you a high confidence trade. But the point of this discussion is not to elicit a high confidence trade overall, perhaps, right? It's just discuss strategies that you could use, right? So let's presume that maybe you're bullish into the July OPEX instead of being bearish, right? Well, naturally, you want to look at that 230 roughly area as a target based upon the current straddle price. So again, going back to our chart, to our option chain now, we look at, go slow. One sec, guys. There we go. We look at a target of 230 approximately, right? So there are many ways you can express this overall thesis. You could go, in the money call spreads. You could go with an at the money call spread, perhaps. You can go with an out of the money call spread. It really depends on what your overall focus is. Do you want higher probability, lower profit trades, or do you want lower probability, higher profit trades? Said differently, do you want to have more units of reward per unit of risk, or do you want to have lower amounts of reward with higher probability, essentially, right? So here you can look at, for example, let's say we said, okay, I think it's going to 230 by expiration. I can buy this call option 210 strike price and sell the 230 strike price call option against it. Now my cost basis goes down to about $6. Now I'm risking 6 and change to make a maximum profit of 230 to 210 is 20 minus 6 is 14. I'm risking 6 to make 14. And this is kind of the way you got to think about your trade structure. Using spreads will be your friend because even though you're going to cap your gains, the intention is not to hit home runs. It's to hit base hits recurringly with decent degrees of profit where your risk is capped. So in this scenario, you're risking about, on a 10K account, 6% of your portfolio to make an additional return of 14% on your portfolio. You might perhaps have a mental stop loss of like 50% of the position, which is what I typically do is I say, okay, if it hits, for example, half the value of my entry point, $3 in this case, perhaps, you stop out, take the loss, admit that you were incorrect, perhaps, and then move on to the next trade, right? A very like automatic approach, robotic approach, some may say, but it's the way that you want to kind of develop your pattern of decision making with respect to finding consistency in your overall outcomes overall, right? So you can go 20 wide perhaps, or maybe you say to yourself, you know what, I'm not comfortable with taking 6% risk. I want a bit less risk, right? Well, if you go out of the money instead, let's say you roll up to the 220 strike instead, 230 call spread. So 220, 230 call spread, long this, short this. Now you're risking $200 and change to make a maximum profit of about $800. You're risking 2% of your portfolio to make a maximum profit of 8%, right? So you're capping your gains, but your risk is much, much lower. And if you again, use the same rule that I use, which is to cut my position if and when it hits 50% maximum loss. If I'm sizing my typical size, then you're going to cut at a loss of roughly $100 or so. So you're pretty much saying mentally, I'm okay with losing $100 or 1% of my portfolio because I have upside here of 8% roughly. And you might not even target the maximum 8% because if, for example, NVIDIA shoots to like 225 tomorrow, would you be willing to hold that trade for the next 30 days where you're risking $5 to make $5 more? The answer is probably not, unless you've in some way de-risked your position where, let's say, for example, you had 2 contracts or 2 spreads and they go from $2 and change to $5. In that case, you sell one of them. Now you have a free position, right? It removes the emotion from the decision making process, which is what you want to do essentially. The Again, I'll say it again and again. The best way to think about trading is not about optimizing or maximizing for profitability. It's about minimizing your emotional attachment to each decision you make, because ultimately emotions are what elicit bad making processes over time overall, right? Like think about a time when you guys have had perhaps a terrible outcome. What has precipitated that terrible outcome? I would wager that you've probably taken some stupid amount of risk on a lower probability trade. Maybe you've averaged in and added to a losing position recurringly. You sized way larger than you thought you would. I had a student a few years ago during COVID, and he made a lot of money during that rally up from like 2020 to 2022, roughly. He made about $5 million roughly. And in 2023, when we had that little bit of the bear market in tech, namely, he started off with one position in the Nasdaq, long tech, and as it started falling, he started adding to it, and before he knew it, he ended up losing 700K, and it snowballed into him making worse and worse decisions overall. Long story short, he ended up losing $3.6 million or so of his 5 million and change of profit that he had earned the prior couple of years. So imagine how terrible you felt, right? But again, that's where it doesn't matter how good of a trader you are. It only takes one stupid decision or one mistake to erase your entire career's worth of good decisions, perhaps, right? Like imagine, for example, Warren Buffett said, hey, I'm going to go in YOLO before I retire. I'm going to take everything I have. I'm going to buy out of the money SPX put options on some kind of hunch or whatever. They expire worthless. It doesn't matter that he made all that money over his whole career and was very, very astute and wise and disciplined in doing it. That one decision that he made just obliterated every past decision he ever made. So again, the same can be said for anyone, right? Which is also why I put little credence into anyone that shows me like one good trade, because ultimately it's what you do day in, day out that will elicit consistency in your outcomes, right? I'm not really impressed by anyone that hits a home run on some gamble, because ultimately it's not a repeatable process, right? What you want to do is find a repeatable process, and using verticals or spreads is a great way to do that, right? Again, you can use call spreads, you can use put spreads. It's kind of, it doesn't really matter. It depends on your overall thesis, right? So let's say you're bullish here again, you're risking 2 to make 8. You could also roll down and have different outlays. Let's say you want to go, for example, higher probability with lower profit. You might go 210 to 220, for example. In this case, you're now risking 4 to make 6. You can see where I'm going with this, right? As you go in the money further and further, the asymmetry of risk worsens, but the probability of making that profit increases overall, right? So you got to kind of find a happy medium there where you're being realistic about your outcome expectation and not being too outlandish and saying, hey, you know what, I'm going to buy the cheapest call option because I can buy a 250 strike call option for 70 cents, for example, right? And a lot of people would do that and say, well, they're cheap, so why not buy that? Well, I would say the probability of that hitting based on the current delta right now is about 7%. Therefore, I would maybe sell that contract and say, you know what, I'm not enthused about buying that contract. So again, same line of thinking can be applied to buying a put spread. Let's say you're bearish. You might say, okay, well, you know what? I think we're going to go to 190. I'm going to go long the 200 strike price and short the 190 here overall, right? Again, similar outlay, risking 2 roughly to make 8. Exact same thought process, just in reverse. I'm bearish instead of being bullish, right? Now, taking this one step further, where when you understand the nuances of option trading, which not everyone does. Most people don't actually. And I've worked with many people that think they know about options because they traded them perhaps for a few years, but they don't understand the nuances behind them. And that's where you get the true edge in understanding how to strategize and manage your risk by understanding the different variables that play into how an option moves. So we go from vertical spreads to now butterfly spreads, right? They're a compromise on taking a directional bias and a very powerful strategy because you're a net seller of options in this instance. for those of you guys that don't know what a butterfly is, it's where you buy a call option or a put option. I'll demonstrate an example here. So back to NVIDIA again, just to keep consistent here, right? So let's say we have the same thesis. It's going to NVIDIA's going to go to 230 a share by July 17th, right? Well, I could, for example, buy a call spread, or I could buy a call option. There are many different ways. Like there are an infinite number of permutations you could take to express your idea here, right? But let's say that I wanted to be structured and methodical with my overall decision-making process and strategy, and I want to keep my risk low with a higher probability of profit, but also be realistic here. So I could do, for example, instead, perhaps a 210 long, 230 short, right? Which is a call spread, right? That we discussed in the first scenario. But now I'm going to take it one step further, and I'm going to turn it into a butterfly spread. So now I'm adding a third leg of the contract. I'm selling two of the middle strike here. So I'm buying one 210, selling two 230s, and buying one 250. Now notice my debit here is $4 and change. My maximum upside is from the first leg to the middle strike, which is $20 wide. And so I have upside here of about $16 based on risk of $4 and change. And you actually have two different break-even strikes here, because essentially if we overshoot the middle strike here and go to, let's say, for example, like 240, you would still win, right? You would only lose if we maximum loss if we overshot past 250. But as we pass through the body, which is the middle strike, each side of this is called a wing, right? So the lowest strike is a wing, and the highest strike is a wing. The middle strike is the body, right? As we move toward the body, the profit, the P&L will actually improve in your favor, right? And as time decay kicks away and we move toward the expiration date, it'll improve more and more and more. So you wouldn't target a maximum profit on this position. You wouldn't target like a max gain, because then you'd be pretty much saying, I think that NVIDIA will expire at 2:30 on the nose at 4 p.m. on July 17th and hold that price into after hours, in which case I would make maximum profit. It's just not a realistic expectation overall. So what you want to do is you want to perhaps think about it in a more realistic framework and say, you know what, if and when this doubles in value and goes from $4 to $8 or $9 or $10, at that point in time, I will then sell the position and reposition myself based upon what I'm seeing at that point in time. Because ultimately, if nothing happens here and NVIDIA just kind of ticks away and time decay kicks in, you're going to see this position gradually increase in profit, because what will happen is the middle strike here will lose most of its value. This contract here has not much value to lose already. And then your highest strike, highest delta contract here will lose some value due to time decay, but because it's within the realistic range of the implied move, you'll still have a fair amount of value there. So I won't get into adjusting position, because again, like the conversation can get really very long here. I could talk for 50 hours on different topics around this, right? And when I work with people one-on-one, typically we spend 25 hours one-on-one going over all these topics, which is why these sessions have to be shorter, obviously, right? So again, the opposite scenario, let's say you're bearish, you would just switch this to a put position, and perhaps you would say, okay, I'm going to buy. Let's look at an out of the money position instead of at the money, right? So 200 strike long. Let's go to, for example, the 185 strike short, and we'll go to the 170 on the long over here. This is a $15 wide butterfly put spread, and now you see we have an outlay of $2 roughly for upside of $15, because the maximum profit here is from the middle strike to the long strike here, the highest strike. So $15 minus 2 is 13. You have upside of 13 on 2 risk, right? That's your maximum loss. And again, if you go back to the rule I mentioned of cutting your position at half of maximum loss, let's say it runs like 230, for example, and it goes to $1, you lose $1. You cannot have any any reward without risk. And another one of my favorite quotes is, in life, the biggest risk is in taking no risk at all. Think about that for a sec. So beyond this, looking at butterfly spreads, there are more permutations of strategies. You can use, call condors or put condors. Again, if you want to Google those strategies, you can. I won't delve deeply in each strategy because the point of the conversation here is how to grow a small account, not how to focus on each strategy individually. If you have any questions about this, I'll DM me on Discord, drop a comment on the YouTube channel. Like one of those things is totally fine, and I'll reply when I can. Let's move forward to the next conversation point. 1 second. So the next strategy here is called a poor man's covered call. This is a more patience required strategy overall because you're pretty much just collecting premium. And essentially what you're doing here is instead of owning the underlying asset, if you own 100 shares of NVIDIA, for example, you have the ability to sell one call option against your position whenever you want, essentially. And you can harvest premium by doing that. So if you have a smaller account, you can't obviously buy 100 shares at 21 grand roughly per 100 shares. So instead of that, you might say, okay, well, you know what? I'm going to buy perhaps a longer dated option. I'm going to buy perhaps, let's go to like August or September perhaps, right? If I go to September here, I can buy, for instance, right now, if I go in the money, again, more risk, obviously, because you're spending more premium. But let's say you buy the 180 strike here for like $36 roughly, right? The break even there is 180 plus 36, which is 216. I can buy this for September OPEX, 94 days away. Keep in mind, my break even is 216. So I can sell call options on shorter durations above my strike price to harvest premium and reduce my cost basis. So let's say, for example, I go to July 17th again, right? The same expiration date. And let's say that I want to sell the 220 strike price call option against my September call option. I can do that. I would be harvesting premium here of about $4.50 roughly on my 36 risk overall. So on that risk there, if, for example, we say below 220, the short strike over here, what would happen? I'm making essentially $4.50 on 36 risk. I'm making 12.5% return on my risk harvesting that position. Now, if it pushes above 220 by July 17th, I may be forced to close the position out entirely. But in that case, I would gain an additional profit of 220 to 216, which is my break even, minus $4 more from the credit received on this short call option here. So I would have a profit there of an additional roughly $10 or so. So my return there would be about 10 on 36 roughly, or sorry, it'd be 10 on 32 because you're reducing your risk from 36 down to 32 by selling that July OPEX contract. So you'd be returning 31.25% percentage return in 31 days. Pretty remarkable percentage return, but again, not without risk because you're holding this long contract here, which comprises pretty much 32% of your portfolio or so. And if NVIDIA sells off heavily, you could see a decent sized loss, although you're buying a lot of time on your contract. So you're not too concerned about it dropping too much in the short term because you have a lot of time on the contract. But again, this is an example of a poor man's covered call where you're harvesting premium recurringly on a longer dated call option. Let's say for example, after July OPEX, we say just below 220, and your call for September is around like $38 or $40 per contract. Well, then what do you do then, right? You look at perhaps the following month, the August OPEX, and then you sell perhaps the 230 call option or the 220 call option again, right? And each time you do that, you got to keep track of your math, obviously, and you subtract the cost, or say the debit cost of the contract from your net cost of your longer term contract. So let's say you initially bought this September contract for 36, and then you sold the July one for $4 and change. Now your cost basis goes from 36 down to 32 roughly, right? Then assuming everything expires worthless, you're still holding your September OPEX contract. Then you sell this contract at the 230 strike for like $6, for example, right? Now your cost basis goes from 32 down to 26. So you can recurringly lower your cost basis there. The only thing is it's just a slow grind, right? Because you're capturing premium every 30 days or so, right? Um, it's a good strategy for smaller accounts, but it's a patience-based strategy where you kind of sit and wait. Not a terrible option, especially if you're looking at, a cheaper stock that has high IV. A good way to look for opportunities is to scan for high implied volatility rank or percentile using a scanner. Again, I won't delve into that topic right now because we're time constrained as it stands right now. So beyond that, if you were to go from a 4 months covered call into a discussion on what happens as your portfolio grows a little bit more, perhaps, right? Well, beyond that, there's a strategy which is very interesting, and there are some funds that actually employ this strategy pretty often. But there is um, a strat called cash secured puts, obviously, right? So cash secured puts are where essentially you have the cash in your portfolio to buy a given asset times 100 shares. And instead of buying that asset, you say, you know what? I'm going to sell a put option. If we get below that strike price by the expiration date, I will be forced to take ownership of that position, assuming I don't close it out prematurely. So let's say, for example, that we look at, again, NVIDIA, just to be consistent here. Although you might find much, much better opportunities than using NVIDIA for this example, right? But let's say that you go to, again, maybe like the August OPEX and you say, I'm cool with selling, for example, the 180 strike put option for $3 as a cash secure put position. Not a lot of credit received, right? You're pulling in $3 of credit. Your risk is 180 essentially minus 3, which is 177. Although I would argue that the probability of NVIDIA going down to zero in the next 66 days is not very high. Nonetheless, it's a very, very slow way to grow your account. Not a wrong way to do it, just a very slow way to do it, right? Because even if you have a margin account with like 10K in it, for example, you would be allowed to sell a cash secure put here because your brokerage would say, okay, well, in a worst case scenario, that person will then own 100 shares of NVIDIA, which will be used as collateral for their position overall. So you can do it if you wanted to, but is it the optimal strategy? I would argue using butterflies or verticals are far more conducive to growing your portfolio in a more timely manner than cash secure puts. Cash secure puts are great if you have a larger portfolio where you have tons of capital and you're trying to cash flow your cash essentially, right? You're like, I have $5 million in my portfolio. I'm going to go ahead and sell whatever, like 50 contracts at the 180 strike price for August. I'll capture, $3 per contract, right? And that is meaningful premium. That's about $15,000 of credit in your account, over the course of 2 months roughly, right? So you're cash flowing your larger portfolio. There is a strategy which you can go beyond as well, which once you get to about 20, 30K portfolio size, there are certain funds that will actually sell the strategy under like a kind of like a mutual fund, like an ETF vehicle. And it's called a short covered strangle. Essentially, you would buy the asset, for example, NVIDIA in this case, you buy, let's say 100 shares. And then what you would do is you would sell a call option against your stock and at the same time sell a cash secure put, essentially selling the strangle, the call out of the money and the put out of the money and capturing that, which would reduce your cost basis overall. So an example of that would be, for example, you buy 100 shares at, let's say 208 right now. Looking at the July OPEX again, let's go back to here. You would sell, for example, the 220 strike price for 450. On the call side, you sell that. And then on the put side, you would sell perhaps the 200 strike put option for 470. Credit received here is, it's not 17, it's like $10 roughly, or $9 roughly. So you're pulling in $9 credit overall. And essentially, if NVIDIA stays between 200 and 220, your cost basis drops from 208 down to like 199 on your shares that you own. And if it goes to 220, for example, it's the upside, you would then make $11 of profit on your position in addition to the $9 you have right here. So you make about $20 overall of profit on 208, which is about like 9% return in the span of a month. Not bad at all whatsoever. Again, this strategy is better for larger portfolios because you can, as you get larger, you don't care so much about the dollar denominated, I'm sorry, the percentage gains. Those gains can be smaller while the dollars are larger, right? If your cost of living is pretty fixed and your portfolio is growing, you're not really concerned about, making higher percentage returns perhaps, but the dollar returns are meaningful because as they balloon, assuming you do not increase your standard of living dramatically. By that I mean like making more money and going by buying a new car, getting a larger house, buying a new Rolex, for example, whatever. Like the point is that if all else remaining equal, as your portfolio grows, this strategy will give you a very, very nice return overall because you can cash flow your larger portfolio and it's meaningful enough that you actually enjoy the benefits of it. Whereas in a smaller portfolio, making $800 or $900 over the course of like, a month out, for example, it might not be very conducive to a good living for most people, unless you have a job or some other form of income that is helping you to live overall. Now, beyond that, the last thing I wanted to mention before we take some Q&A was liquidity, right? So we focused on all these different strategies, but the important thing is you want to use these strategies only on liquid options where you have very tight bid-ask spreads, like SPY, triple Qs, NVIDIA, Tesla, for example, whatever. Any names that have high volume trading on the underlying asset. So like if you look at an option chain on a given day, and by the way, an easy way to correlate this is looking at the average daily volume a stock trades on a given day correlates heavily with the amount of volume each day on the option chain. So for example, if you look at NVIDIA today, it's already traded 1.13 million contracts in one single day. Today, I think SpaceX has traded like, I don't know, a crazy amount of contracts. What are we at now, right? 1 million as well, right? A Microsoft, for example, right? You can go on and on about this, but like the point being is that if you're using strategies where the spreads are very wide, you're going to have a lot of slippage, meaning that if you want to buy a position, you need to go closer to the actual ask price, meaning that you're paying a higher premium overall. And then when you want to sell it, you need to go closer to the bid price. So that gap right there is called the spread. And the wider the spread, the more the slippage you're going to incur overall, right? Kind of why also people don't really trade heavily NDX options on NASDAQ because the volume isn't as high there as, for example, SPX, right? So you want to have typically very, very tight spreads. If you notice that the spread between the bid and the ask is in excess of 10% of the overall cost, you want to stay away from it, right? So let's say, for example, it was like a $5 cost for a contract and the spread is like 50 cents or more, you want to stay away from it. Typically, you want to be in for like a 10-cent spread, 20-cent spread, not really more than that, because otherwise slippage will eat you alive and will eat into your profits. And pretty much every trade you start off at a loss because you paid more than you should have for the contract. And when you sell it, you're going to lose a bit of money on that as well. So keep that in mind. That's also why, if you guys notice, when I talk about predominantly mega cap names, because I'm always trading pretty much highly liquid names that have no slippage essentially, right? Or low slippage. So beyond that, I think we're finished in this conversation for strategies. We're about 45 minutes in roughly, guys. Let me just make sure I covered everything here. Yeah. So avoid options where there's no liquidity at all. If you find some like random biotech stock or like whatever the name is, if it has no volume in the option chain and the spreads are wide, just avoid it. They will eat your lunch. The spreads will eat your lunch, okay? And the last thing is strike an expiration selection. So there's 0-day versus weekly versus monthly. There are different trade-offs, right? 0-day trading, whatever you put in, be ready to say goodbye to because that money could be gone that day. But also, you can have crazy asymmetry of risk because you're paying a much, much lower premium for a given contract, right? If you go to NVIDIA and look at, contracts expire tomorrow versus, a week out versus a month out, let's say we get a move on NVIDIA. Wait 1 second, go back to the option chain again. And then we'll do Q&A right after this, guys, too. So let's say, for example, on NVIDIA, you go to tomorrow's OPEX. Oh, sorry, this is triple Q, right? So actually, this is fine too, right? So you can trade 0 days on the Qs today, right? It's currently at 12:44 p.m. Eastern time right now, and we're at 7:35 roughly. Let's say you buy this contract, 7:35 strike call option. This expires in like 3 hours time, basically, right? So you might buy this contract for $130 roughly, but unless you push above 735 by at least 130, you're probably going to lose money on that position. Although, if we get, for example, some crazy headline like, I don't know, it could be anything, whatever. I mean, we've seen the craziest headlines the last few weeks around the Iran war, where they're like, yeah, we have a deal. No, we're attacking. No, we have a deal. No, we're attacking, right? And what happens? The price action on 0 day contracts is absolutely insane. Like I remember, I think it was last week on Tuesday, like 1 week ago today, where we had that V bottom on SPX, and they were out of the money contracts. It went from like $2 each to like $5 a piece. Sorry, $50 a piece. So it turned pretty much like $200 into $5,000 in the same day. But again, looking at it at that point in time, you're like, okay, well, the probability of us recovering 100 points in the last 4 hours of trading isn't very high, right? So I would say that growing a small account is all about patience and discipline. Chasing those fast returns will typically erase that aspiration by depleting your account such that you see it get cut in half, and then you get more laissez-faire with your more cavalier with how you're handling your funds, and then before you know it, you pretty much burn 10K in capital. And I'm sure many of you guys have done this before in the past. I mean, I know many people that have blown up accounts. The point is, think about this as a practice round for when you have more capital by saving your money from your job or whatever it is that you do to make money. And as you're practicing and learning your process and honing your process, you can see the results in real time, right? If you can make, 5K off 10K over the course of 6 or 7 months, which doesn't sound very sexy to most people, but I think it's a very, very good learning experience. You're probably going to be able to make, for example, 50K off 100K, right? And as you scale more and more, the same things apply. But the problem is those fast gains that people chase, where they take binary outcomes, like, for example, 0 day contracts where they buy a whole bunch of them, hoping for a massive home run. It's not a repeatable process. You might get lucky one time, but if you do that every time, over time, you're going to be at zero pretty much. So I will end the discussion there and open up for Q&A. Any questions here, guys? Let's see what we have in chat here. Okay, so yeah, someone said we should rename the series from how to build your small account to how to stop making your small account smaller. That's a good point. Yep, looks like Fidelity. Chris asked, Nick, if you do the fly on any American style option, you just want to make sure you close it up before expiration, correct? Yes. Very, very good question there, Chris. If you're opening a butterfly position and you're holding it toward expiration, you want to be sure you close it out, because if you don't close it out, what will happen is that assuming you have the capital in your account to actually take ownership of your position, you will then be assigned, let's say, for example, on NVIDIA again, right? Let's say that you bought that 210, 230, 250 call fly, and we expire at like 215, for example, right? And you forget about it. What'll happen is that if you have the capital in your account, your brokerage will say, okay, cool. Nick wanted to own this position. He didn't close it out. Therefore, the call will be assigned, right? What'll happen there is if I own the call option, I'm going to call away 100 shares from someone else's account or from my counterparty. Therefore, I'll be long 100 shares at 210 in my account on the following Monday after expiration. So very, very important to think. If we're above the middle strike, that's where it gets kind of funky, because if you have the capital in your account to take assignment of the whole position, what would happen then is that if for example, on a call fly, let's say you had 210, 230, 250 again, right here, right? And you're short. Remember, you're short two contracts at the middle strike. Let's say this happened right here, right? Well, if we expired at, for example, like 232 and you forgot about it, what would happen is you'd be assigned the call option at 210 and two of the call options at 230. So in essence, the one of the calls would be washed away because you're long 210, but you're short 230. One of them would be washed away, but the second contract would be assigned to you. And because you're short a call option, that means that you would have shares called away from your account even if you don't own them. So what would happen is on the following Monday following expiration, you'd be short 100 shares in your account of NVIDIA at 230 per share. So if they had news on Monday morning where they were like announcing some new product or something like that and went to like 250, you'd see a massive fat loss. So always close your positions out before expiration. Or if you're using IBKR, there is an actual option to lapse your contracts, right? You can say lapse your contract, but that only applies to long contracts, not short contracts. In this case, you're long 210, you're short 230. If you're above 230, you have no right to say lapse. If you let it expire, assuming you have the margin in your account available to actually take assignment, you will then be assigned on the Monday following expiration. So good observation there, Chris. And good question as well. John asked, operationally, what goes into your consideration when choosing July or August OPEX or far out expiration in general? I know the literal definition of, let's say, higher IV further out, but what's on your mind? So, I mean, when I look at expiration date selection, I'm looking at perhaps, is there a binary event following that expiration date where I'm paying a premium for that? An earning event, for example, right? Is there some kind of, like macro event like FOMC, which is tomorrow, for example, right? Is there an election in November, for example, right? If you're buying longer dated options, they don't really price in those events because you're paying much, much more nominal prices on a daily basis. A good practice to kind of use if you want as a kind of like a exercise, look at different contracts across different strikes and divide the cost of that contract by the days of expiration. You'll notice that the more time you buy, the less you're paying on a daily contract, right? Being like a decent metaphor for this would be kind of like buying auto insurance, right? Let's say, for example, you could buy auto insurance where you're paying like $500 a month for your auto insurance, and if and when you need that auto insurance on a given month, you then use it and it's useful to you. But if you buy it, for example, like a year out, maybe you're paying, instead of paying $6,000 a year, you're paying like $3,000 for the year, right? A much, much cheaper cost overall. The reason being is that you have it there in the event that you need it over the next 1 year period. In the same vein that anything can happen when you buy a call option that expires in a year, for example, right? The time decay is very low. Typically, the IV is low because no one else in the market is really focusing on those contracts. Most participants in the market are focusing on short duration contracts because they have the best asymmetry of risk. Or if you're an option seller, you're like, you know what? I want to capture premium. I don't think NVIDIA is going to go to 215 by Friday. I'll sell the Friday contract, assuming there was a Friday contract. This Friday is a holiday, by the way. So, but yeah, you want to look at IV skew, John, and you want to look at obviously binary events, right? Are there competitors reporting earnings before me? Is there some industry event? Is there some macro event, for example, right? A lot of things go into your overall thought process, as well as what is my overall thesis here? Am I long-term bullish? Am I short-term bullish? Am I medium-term bullish, right? Am I short-term bearish, medium-term bearish, long-term bearish, right? Many things that go into the thought process there. Again, when I teach people one-on-one, which I do, like I've been doing for the past 11 years roughly, we talk about all these different topics over 25 hours roughly. So cramming all that into like an hour discussion is impossible pretty much. Mike asked, question, on a 10K account, you can't buy 100 shares of NVIDIA. So this or the per month covered call example both use a large amount of the account or all of it in one shot. Yes, that's correct. Yeah. So if you have 10K in your account and a margin account, your margin will allow you to buy 100 shares of NVIDIA, probably, depending on what your broker is. But that means that you're using pretty much your entire account in one position. Yes, that's correct, right? So if you use a per month covered call, you'd be using, in the money call options. You can also buy shorter duration if you wanted to. And because NVIDIA has, for example, Monday, Wednesday, Friday expiration, you could be Q with it and try and sell, Monday out of the money options or calls, then Wednesday out of the money calls, and then Friday out of the money calls, recurringly pulling in more premium. But again, I think less is more, especially with smaller accounts. You're better off taking mid to longer term positioning, and then like having a thesis where you have good asymmetry of risk. Let it play out over time, and this way, if you're incorrect, you're not getting burned too fast on 0 day contracts or something expiration. You see pretty much a binary outcome, either a big profit or a big gain, right? I mean, sorry, a big profit or a big loss. Hope that helps, Mike. Okay. John posted, I saw Willie's far out of the money 0 DTE call when we went 75-75. It made sense. Bar expiration feels harder to discern. Yeah, it's more of a comment there, I guess. John asks, Nick, what are your thoughts on selling a put around support a year out and buying shares with half the premium to close at 50%? So I love that strategy. That's a strategy for larger accounts, right? Like when I talk about in the morning meetings, um, especially during times of higher volatility when the market's lower typically and VIX is higher, you want to be selling out of the money put options to finance call spreads perhaps on names you want to own. Like right now, Microsoft is at 390-ish. Selling a 350 put option below the current lows of the year to finance like a 400, 500 call spread is not a terrible idea overall, right? But you want that higher IV across the board to sell a premium. Again, when you go out that far in duration, typically the skew favors lower prices for longer dated options, right? You're paying mostly for time premium. There is some Vega baked in there as well, obviously too. I think Willie asked, I'm assuming a short collar position will require both the shares and the potential cash to cover the put being assigned. Yeah, if you're shorting a caller, so I guess you mean to sell a call option to finance a put option? I mean that would be a long caller, right? A short caller. I'm not sure what a short caller is. Do you mean selling a put option to buy a call option? I'm going to assume just a caller, right? So a caller is where you own 100 shares, for example, and let's say you own 100 shares of NVIDIA right here. What you could do, and this is kind of a cool strategy too, is you can use something called a calendar caller. I'll explain a caller first, but basically, let's say that you bought 100 shares right now. You said, you know what? I'm going to cap my gains, but I'm going to cap my losses as well over the next 30 days. So I'm going to sell, for example, the 230 call option against my 100 shares, and I'm going to use that premium, 235 roughly premium, to finance let's say the 190 strike put options. So I'm capping my gains at 230, but I'm also capping my losses at 190 as well, right? Great strategy to use through binary events, like again, like midterm elections, elections, FOMCs, any kind of binary event. Callers are great, assuming you do not mind losing your shares at the call strike price because you might lose your calls, for example, right? I mean, your shares, for example, right? There is a better strategy, which I like as well, especially when IV is very high, is to look at selling calendar calls where, I mean, calendar callers where, for example, you would sell, let's say, the January position. Let's say you bought 100 shares of NVIDIA right here today, and you're concerned about perhaps next earning event or something like that, right? Well, you can go out of the money, sell the 250 call options for $15 a piece, take that premium and use it to finance insurance through binary events on shorter duration. Let's say, for example, you want to hedge yourself through August, right? So you go to August, you're like, you know what? I'll buy the $200 put option here for $8 and change. And because you pulled in premium on the January contract, you're now hedged into August, not beyond that. You're capping your gains into August as well, but you have a credit here of $6 roughly. So let's say we pushed like 250 by August. You might be like, yeah, you know what? I was cool with capping my gains, not a big deal, whatever. But also, I'm not concerned about losing money in the short term if there's some kind of new binary event or exogenous risk event or whatever happens in the next couple months. I hope that helps there. We're approaching an hour, guys, so I'm trying to cut it off after, let me see. Last question here, okay? John asked, different John. There's like 3 or 4 Johns in this chat, common name here. Can I ask around how many strategies you simultaneously manage at a given time? I'm trading a lot of strategies at once. You know, I have cash through puts out. I have leaps out on certain names that I own. I have call spreads. I have butterfly call spreads, butterfly put spreads, perhaps, if I'm so inclined, if I'm bearish, perhaps. I'll have calendar spreads out. Yeah, like basically the way you got to think about it is like understand each strategy, kind of like a chess player understands what strategy to use to counter their opponent. Whenever I see a certain scenario, I'm like, okay, what's the most optimal way to approach this scenario given my current thesis and my desired reward to risk ratio overall? So hopefully that helps, guys. We're at an hour right now. I'm going to cut it off right here. You guys were great. Thank you very much for your time. If you have any comments, I'll drop them below in the YouTube video below. I'll post the recording as well for you guys. And if you have any questions at all, hit me up in Discord as well. My name is Braxton in the chat, so you guys can find me there. Otherwise, guys, hopefully that was great and informative. Have a great day and manage your risk, and we will talk soon.